So I'll continue on with these questions that people have left. I'll move on to David's question. Tips for building for retirement fund when starting again at age 55. It's really all those same strategies. It doesn't matter when you start, the same sorts of strategies apply. So looking at saving tax through salary sacrifice, transition to retirement, all those depending on your income level, the spouse contributions, government co-contributions. Go back and review the webinar, the superannuation webinar that I did, or download it via the podcast, Your Money, Your Life podcast. Lots of strategy that is there. If you haven't owned your own home that you've lived in, first home savers account, add all those up and they actually work quite well. The other option is to go out and then start to borrow to invest. It's a riskier strategy, but it does get you some exposure to potentially to the property market. But there are risks associated with that as well. So, there's a range of strategies. You can also look at the share market, investing in that. So, leverage to invest into the share market. Again, it's whilst I've had a margin loan in the past, I don't generally encourage them that much these days. Really, really like to see people focus on debt. And at 55, the benefits of actually salary sacrificing and ploughing money into super are actually often close to taking the massive amount of risk by going out and borrowing to invest. So, consider, I guess, those range of strategies there. It depends on what your personal preferences for risk are as well. But the salary sacrifice and transition to retirement works well. So we've got Alani. I've started my own business as a sole trader whilst also being employed, and my husband is employed and well paid. Is it better for me tax-wise to contribute to super from my self-employed income, or better for my husband to do salary sacrifice on his higher income? What would be financially the best for us as a couple? Great question, Alani. This really gets down to who's on the higher marginal tax rate. You're going to save more tax by salary sacrificing or making deductible contributions from self-employed income from the spouse that's got a higher tax rate. And basically because the benefits of salary sacrifice, as if you go back to the superannuation webinar recording at cornerstonewealth.com.au/super video, the recording's there, the one on salary sacrifice. The formula for the benefit of salary sacrifice is your marginal tax rate less the 15% contributions tax rate, in brackets, multiplied by the amount of your contribution. And so if you're on a higher marginal tax rate, the benefit is greater. So assuming, if I understand it correctly, your husband's on a higher marginal tax rate, then it'd be best for him to salary sacrifice. But he's also got to be cautious about the contribution limits as well, because if he's on a higher income, he's also paying a high level of superannuation guarantee, so he might not be able to put a great deal more into super depending on his age, whether he's over or under 50, and whether his employer, how much superannuation guarantee his employer is putting in. Kathy asks how to make the most of low income and reducing tax paid by voluntarily contributing to super. Smallest tax payable, largest contribution. All those same strategies, Kathy. It's pretty simple to, if you're on a low salary, co-contribution, spouse contribution if you've got a low income earning spouse, and salary sacrifice if you're earning more than $37,000, or sometimes possibly because of the low income tax offset, even $30,000 if you're earning more than that. You could salary sacrifice down to $30,000. Really, they're your main strategies. Just moving through other questions. Ali asks, I'm new to work and super, etc. I'm also younger and really do not understand super or how it works. What do I need to do, etc.? I reckon your first step would be go back to that superannuation webinar series, either do it via the Your Money, Your Life podcast or the videos on the website, or I've also got them, well, they're actually uploaded to YouTube. So we've got a YouTube channel, which is youtube.com/askgav, ASKGAV, and all the videos are on there as well. There's a few more people still online, so feel free to... sorry, we got Jim. I've got actually... I'll open the line up to you, Jim, but I've got your question down here somewhere. Here we go. G'day, Jim. How you going?
Pretty good, thanks, Gavin. Yes, I believe you do have a question there, but the one that I've just been a little bit querying is one on non-concessional contribution levels in pensions. And I partially answered that, but I may have missed it.
So I've just put up your question here. So, has the recent budget altered any of the following? Non-concessional contribution levels to Christian pensions. You can't actually contribute to Christian pensions, but you can contribute to super that can then roll over to pension phase. But the non-concessional contribution limits are still the $150,000, so that they haven't been indexed up. And the work qualification requirements for contributions to Christian pension. Well, yeah, I'll assume that's Christian super. Yeah. The work qualifications to contribute, if you're under age 65, you can contribute. There's no worries, but it's 40 hours in 30 days is still the rule. So satisfying that in the financial year means you can contribute throughout that year. And then the final question was minimum drawdown levels for the 2011-12 financial. Oh yeah, we did that. We addressed that earlier, didn't we? Which is 3.
That's all I had, thanks.
Yeah. Okay. Well, thanks for joining us again, Jim, and thanks for sending through the question. Yeah.
Thank you.
Bye-bye. How can I make an investment property work for me? Really, an investment property, making that work for you is really all about saving a large enough deposit so that you don't have to borrow too much and put yourself under too much pressure. And also, if the property market does come off a little bit, then you've got a little bit of buffer there as well. So saving that large deposit, a great way to structure that if it's your first property, is to go down the track of buying putting the money into the first home savers account, get the co-contribution, buy your first home, live in it for 6 months, 6 or 12 months, depending on what the state-based requirement is, and then you can count the property as your primary place of residence and then move out and lease it. And the great thing about it being your primary place of residence is that if you sell it in the future, it's capital gains tax free. So if it does appreciate in value, like you would hope it would, then you don't have to pay any tax on it, and you can actually lease it out for 6 years before a pro rata capital gains tax would apply. Or if you go and live in it again, or it's vacant for a time, for another 12 months, you can reset that 6 years again. So you could go and live it for 12 months and then move out again, lease it again for 6 months, and it still maintains its primary residence capital gains tax-free status. Just got a question from Tim. I'll just try and unmute your line. I think it's unmuted if you want to ask a question.
Yeah, I'm just wondering, are there any changes to the limits on additional employer contributions to super in the new financial year?
Employer contributions, so your employer making contributions over and above the superannuation guarantee, or it's your own business and you're making it yourself effectively?
Both are applicable.
Yeah, well, it's probably the same answer anyway. It's a bit of a superfluous question just trying to understand your circumstance. But yeah, it's still the same limits, so $25,000 for those under 50 and $50,000 for those over 50 for the next financial year. Yeah. Do you have any other questions at all, Tim?
No, that's it.
Great. Thanks for joining us. Thanks for the question. Options to maximise payments to super for salary sacrifice, spouse contribution, and post-tax amount. Let's see what's this for salary sacrifice. I guess your salary sacrifice as much as you can afford in terms of cash flow. So and down to either $37,000 or $30,000. The last time this financial year, if your salary sacrifice down to $30,000 because of the low income tax offset, it saves you an additional $400 to do that. So the two thresholds that we talk about salary sacrificing down to is getting your income down to either $37,000 or $30,000, depending on, say for example, your cash flow was tight, you might make it $37,000. If your cash flow wasn't tight and you had a bit of surplus, then you might make it, salary sacrifice your income down to $30,000 or $30,000 taxable income. Spouse contribution, you just take advantage of it if it applies to you. We mentioned that early on in the session. So that's Tony's question. Jill, are novated leases on new vehicles a good tax saving strategy? I kind of gave my opinion on that throughout the budget spiel. I'm not a big fan of them. I reckon, particularly with the new changes to how the fringe benefits are calculated with new arrangements that are put in place after the 10th of May this year, 2011. They're going to become less attractive, but generally the ones I've reviewed, most cases, because of the leasing component of it, you're often better off just going out and buying a good quality second-hand vehicle and driving it for 10 years. Tim asks, what limitations are there on reducing my taxable income via making additional contributions as an employee or contractor? So the limitations, I think this might be your question, Tim, who I just spoke to. It's the $25,000 if you're under 50, $50,000 if you're over 50. That's your limit, basically. Daniel says, what is the most tax-effective income stream for people near retirement using their super? What is the most tax-beneficial income for people near retirement using their super? Oh, yeah, that is it what used to be called an annuity? I'm a male, 63 at the moment. If you're a male and 63, generally the most tax-effective and flexible structure is the account-based pension, or if you don't satisfy a condition of release, then it's a non-commutable account-based pension. They're basically the same thing, except you can't commute, or you can't pull out lump sums from the non-commutable pension. But that's generally the most flexible one. Christian Super's got a product called Christian Pension, and that's basically an account-based pension or a non-commutable account-based pension. So that's basically it, Daniel.